Welcome to a very special edition of our show. We are live at the Money Show in Orlando. I'm Jim Iuorio. That over there is Bob Iaccino. Today we have one of our old friends, Keith Fitzgerald of the Fitzgerald Group. Keith, how are you?
Thank you so much for having me back. It's a pleasure, as always.
Pleasure's ours. Before the camera started rolling, we were talking about trips to Italy and riding motorcycles.
Yeah.
Do you ride your motorcycle every day?
As many times as I can. Yeah.
Does it rain all the time in Seattle like they show on the TV?
No, that's something we tell everybody so nobody else
stays
moves there.
away. Well, that's brilliant, actually.
Yeah. But
it's working.
It does work.
Yeah.
But here's the thing, though. Riding motorcycles is really interesting. It's like investing. If you know what you're doing, there's no such thing as a bad day on the bike. Yeah. And so, to me, there's no excuse for that.
Do other drivers on the road sometimes not see you and scare the crap out of you, or no?
No, because we ride very defensively. We ride our ride, not anybody else's ride. So I've never, in all the hundreds of thousands of miles and decades I've been riding, ever had a close call.
Yeah, tell me if this is crazy, because I ride motorcycles, and I always thought to myself, well, a lot of people get hit and they die, but I can always pick out the kid who's going to get hit. He's some guy on a sport bike who's doing wheelies, who's cutting in and out of traffic.
This is a dumbass.
When I rode my motorcycle in the city of Chicago, I felt safer than when I did on country roads, because your head's on a swivel, you're always looking till you get in an open area where it actually then kind of hits your soul and you're happy to do it again.
Well, but that's the problem, and it is really just like investing. The parallels are staggering. 95 to 97% of all fatal motorcycle accidents are rider-induced, not car-induced. Rider-induced, because they're riding over their abilities, they're riding ahead of their safety window, they're riding because they're not observing, they're doing something stupid like talking on their cell phones, riding in flip-flops, eating a cheeseburger. But 95 to 97% are rider-induced. So the idea that you're suddenly at risk because you're motorcycling is patently flawed. The data doesn't support it.
Speaking of Italy, you ever see those guys on the scooter with the cigarette, the cell phone, riding with their
one hand,
going around roundabouts?
Yeah, it's crazy, and cars are zipping around. I remember we're sitting at a cafe by the street in Rome, and my brother just all of a sudden he reaches out and he grabs my arm and pulls it here, and a car comes and hits me, like touches my shoulder. What the hell? Anyway, for all you people who tuned in to talk motorcycle talk and
markets.
Oh, do we talk about markets sometimes?
Theoretically, yeah.
Theoretically, we do. So we do have Keith Fitzgerald. As long as we have him, we're going to break from motorcycle talk and go to markets for a second. So I want to talk. I don't know if you guys have heard this. It's been in some papers, not all. Apparently, there's an election coming up in close to 3 weeks. Have you guys
heard about that?
You did hear about that.
Yeah.
But anyway, there are massive policy ramifications with this election. We do not like to talk about politics, as we've said on either of our shows. We love to talk about policy because policy has a lot of implications for investing. Do you believe this particular election has a lot of policy implications, and if so, what?
Well, so here's my take on that. And this is financial heresy, right? So our research suggests that the markets have a very defined upward bias, regardless of administration, regardless of side. So we say we do money, we don't do politics. We focus on the companies that are going to go. Now, the policies you're talking about are going to impact the companies, no question about that. But to me, I'm going to use any election-induced volatility, be the carrot or the stick, as an opportunity, because the great companies are already looking 3, 4, 5 cycles beyond the current election.
Okay.
So that our view on it is yes, it's going to be controversial. It's maybe the most contentious election we have in human memory, and in living memory certainly. But it's also potentially a massive opportunity because you get this volatility window, this marvelous volatility window of about 18 months, and then things calm down and you get back to the races. So if you're an investor, you've got this marvelous piece here to go. If you're a trader, you've got this like a snake in python. That's eating. You've got this big volatility window that's great.
So there's something I've been wanting to ask you, and it actually, was reminded of my hotel room this morning. I was watching one of the financial news channels, and they're talking about a new product about basically ETF pairs trades built into ETFs.
Okay.
You may not have heard about this yet, but what they're doing is they're taking individual stocks and they're pairing them together as one ETF. So one of them was JP Morgan versus MicroStrategy, right? And one of the newscasters was saying that it was basically Jamie Dimon versus Saylor, right?
Right.
Do you think the market's getting saturated with products we don't need? Do you think this is just people chasing the juice as we say that.
Sure. I mean, I am in the latter camp. I mean, I think that, really, because really what you're talking about at the core is a dispersion trade. You're talking about managing that risk envelope, and you're talking about picking two disparate stocks that theoretically are going to give you that, right? So my take on it is products like that are a dime a dozen. They're coming with incredible frequency, and the reason Wall Street can sell them is twofold. Number one, they can continue to perpetuate the myth of diversity, but they can also harvest uncertainty from unsuspecting investors who don't know any better. So, if you're a professional trader and you understand how those things are put together, then that's one thing. But if you're the average investing public and you're just seeing an ETF that's coming out of nowhere, my belief is that those things are going to be really dangerous.
Can you talk a little bit more about the myth of diversity? I've heard you say that before.
Sure. So again, this is financial heresy, but our research shows very clearly that diversification worked once upon a time, and it worked for a long period of time. But the markets have changed radically over the last 20 to 30 years. The increase in computerization, the rise of zero DTE options, the emergence of dark pools, hedge funds, off exchanges, electronic exchanges, have all created an environment where people are playing not to lose instead of playing to win. Now, Wall Street knows this because they've done the research just like we have. If you're out past 25 or 30 stocks, you are adding risk but not incremental return. So these investors who are being led to believe that you diversify by adding more and more and more securities, it's like rearranging the deck chairs on the Titanic. Diversification is actually holding you back. It fails at the worst possible moment because all correlations go to zero and the thing goes down anyway. And then on top of that, you're over diversified. So you're in fact reducing your profit potential. Now, the problem is not that diversification is bad, but diversification as it is currently sold is completely misguided. The real problem is that investors don't own enough of the right stocks. So, yes, if you look, for example, at the last 20 years or so, and forgive me, but I'm recalling these numbers off my top of my head, but if you look at the SPY, you're talking about a CAGR, a compound annual growth rate of 10.62% or so, 600 and I want to say 72%, 600 something percent over the last 20 years. The SPY, very popular ETF choice. Great. Until you realize that NVIDIA is 121,000, Apple is 13,000, Tesla is 7,000. So the issue is many advisors under the guise of diversification are deliberately holding their clients away from stocks like that because they are playing not to lose, when the smart investors are saying, how much do I need to own to win? So the diversification, again, is not bad as a concept, but the way it's being applied, I think, is going to go down as one of the greatest lies foisted on the American investor in history.
So
despite the fact that it's taught as dogma at universities worldwide.
Sure. So you just mentioned, we mentioned NVIDIA, we mentioned Apple, we mentioned the Magnificent Seven. And the run has been unbelievable.
Yeah.
Now, when you look potentially a lower rate environment, which supposedly, I was always told that growth stocks love lower rates. Now Russell likes them more, whatever the narrative.
Sure.
The pair. Do you believe that those could potentially have less returns just based on the returns they've had, and that the Russell's a better place to be? Have you rotated anyone at all?
No, as a matter of fact, we've done the exact opposite. And the reason we've done the exact opposite is because the large, big cap names in particular have got the strongest balance sheets, the most efficient top to bottom profit mechanism, the best reward to risk ratios, and on top of that, the highest liquidity concentration. So the question people constantly ask me is, what's the next hot stock? That's a mistake. The question you really want to ask as an investor is, what are the stocks that are going to be there in 10 years, in 20 years when I need them? That's a very different thought process. Now, if you want to go small caps, there's nothing wrong with that, but you got to understand what you're getting into. What we know from our research is that 70, 80% of the small cap stocks don't make it.
Be there, right? Yeah.
They're not going to make it. I mean, they're dead on arrival. So if you look at the news and you look at what's happening, the question you've got to ask yourself as an investor is, why on earth would you buy that when you have an Apple or an NVIDIA or a Tesla available to you?
Yeah, that makes sense.
It's a very different, it's like into a wall for most investors because they've been taught for 20, 30, 40, 50 years that you spread your money around willy-nilly because nothing fails at once. But what they're not asking themselves is what happens when you miss the runners? What happens when you miss those things that go?
Okay.
And that's a very real question.
And I like that answer a lot, but I'm going to switch some because I want to talk about oil for a second. So I'm going to actually ask Bobby a question, then you get the next question too, Bobby. Keith said that as a general rule, who wins this presidential election is not that important, and I agree with that. I think both of them, particularly these two candidates, both of them spend money like drunken sailors. We're not going to have any deficit reduction. That should bolster anything denominated in dollars because it's beating the crap out of the dollar at the same time. But in oil specifically, I think there's something that's interesting because they're certainly diametrically opposed, particularly considering what Kamala Harris used to proclaim was her stance. Do you think, as my theory is that both of these candidates could be, or Donald Trump could be bad for oil prices because he could be drill, baby, drill. Kamala Harris could be really good for oil prices if she backs off, doesn't allow fracking. What do you think the implications are, particularly, and then the big integrated companies as well?
It's a couple of things in my view. I see reflation as being the narrative now. So I was on Bloomberg. Was it Bloomberg? No, it was Fox the other day. And I was on Fox Business News, and Neil Cavuto said to me, how long is this bull market going to run? I said, I'll say 8 years. Now, I'm not saying it's going to go 8 years without any sort of dips. I expect multiple 10% corrections, probably a couple 18 to 20% corrections in that 8 years, which is typical.
Yeah,
right?
absolutely.
But I think both candidates are inflationary. And in reflationary regimes, which people think inflation is bad for stocks, it's not. No. Especially when the Fed's not fighting it. Because stocks are an asset. People forget about asset inflation. Crude oil is also an asset. So if I'm right that it's going to be reflationary, it almost doesn't matter. You look at let's just assume that former President Trump is going to be drill, baby, drill. That's 3 years minimum. And U.S. production is declining already. Rig counts have been declining for 18 months. So even if he's like, okay, let's start drilling, you're not getting oil till 2027.
But is the oil market forward-looking like the stock market? Can it look 3 years into the...
It
not
is.
really, though, right? Not
well,
as much.
The oil market itself has got too many other supply shocks. Generally, with crude oil, you get slow drips to the downside and huge shocks to the upside, right? But from the integrated standpoint, if we're in a reflationary regime, if you look at an equity sector backtest, energy is one of the best performers in that particular.
But not just the commodity, but the stocks as well.
The stocks specifically, the energy sector.
Particularly if someone like Trump is coming in and perhaps could deregulate, stop threatening to grind them into the dust like other administration has.
Well, don't forget too. I mean, one of the other things that people don't realize about, you talk about the continuity of energy. We look at it as a continuum. It's not an on-off switch. People constantly think about it an on-off switch. Well, the reality is we're going to need dinosaur juice for a long time to come.
Preach.
But the interesting part about that is that if you look at who's investing in alternative energy, it's the energy companies that are investing in alternative energy. So the recent headlines about nuclear plants and all these other things pale in comparison to alternative energy that Chevron, British Petroleum, any of the other big majors are developing as part of their venture capital arm. Yeah. Because they know that there is a lead lag cycle. They know that that time window you're talking about is there. They know it's real. And they've got to have something in place 5 or 10 or 15 years from now.
In all honesty, when those big companies starting their green initiatives, I read that as trying to appease the radicals. Do you think they're really serious?
Oh, absolutely.
Okay.
No question in my mind. And Chevron in particular, if you look at Chevron, for example, personally, we're invested in a company called Zap Energy, which is working on nuclear fusion. And they are very, very close to making it happen using a technology that does not involve football field-sized magnet fields and billions of dollars for one single shot. They're talking about a pinch.
Give me the name of the company again.
Zap Energy. Now, it's privately held, but we are invested right next to Chevron's venture arm. And so, I look at things like that. If we look at, I know, for example, that they have already flown aircraft on algae. I know that we're talking wind, we're talking solar, we're going to be doing things with energy storage that we can't even contemplate today. But yet those funds and hundreds of millions, billions of dollars are already being spent on generational jumps in technology that are not yet even in the public's eye.
So do you like the big integrateds as a longer term hold?
Absolutely.
That's what I thought so too. Do you have favorites among it?
Chevron.
Chevron, interesting.
Bar none. most efficient top to bottom, tied closely to oil, super efficient balance sheet, super strong balance sheet, very high shareholder return. It's, I think, the listed dividend is in the 4 or 5% range. The shareholder yield, the true shareholder yield with buybacks and oil and listed dividends is about 9 and something percent.
Okay.
So yeah, you bet I do.
Okay, so apparently Bobby and I are gold bugs. I didn't know this would happen, but over the last couple of years,
you
it's kind of a
guys,
joke.
I'm telling you.
Yeah, it's kind of a joke.
Right?
No, 2 years ago I thought gold was going to be a place to be. I thought stocks too, by the way, too.
Yeah.
Stocks I thought would be subject to a few more up and down 8% moves.
Sure.
They are. Okay. So in the last 3.5 years, S&P's up 54%, gold's up 45%, but beating it this year. Are you interested in gold, or do you think gold is the barbarous relic and doesn't belong in a progressive portfolio?
No, oh boy, that's an interesting question. I think that every investor should own gold. The question is how and what that looks like.
Yeah.
Right?
Guard
And
dogs,
so-
guns.
Yeah, something. Here's the thing, right? Because people constantly focus on gold as if it's going to be a hedge against inflation or uncertainty.
And it often isn't. Right. Yeah.
Hurricane Katrina, Hurricane Helene, Hurricane Milton wiped out an area the size of Great Britain. They were not trading gold for cheeseburgers and medical supplies. They were trading medicine, diapers, bullets, diesel fuel, and gasoline. So if you really are concerned about owning gold as a hedge against calamity, I think you're making a mistake. If you're looking at gold and saying, okay, I can use that to stabilize the overall volatility of my portfolio, now you're onto something.
That's interesting.
So to me, it's very viable. I think every investor should own it, and you might as well have some fun with it. You know?
Yeah.
Get some rings, get some jewelry. I mean, I like
Damn
buying
straight
my
bling.
prized
I wear
jewelry.
like a big thing
I mean,
out to the bars at night. Yeah.
Exactly.
All the hip guys are doing that.
It's there.
It's funny to me. This might be the first time in 8,000 years or however long gold has actually been valuable to us bipeds that you actually have younger generations are just less into things.
Yeah.
They're less into diamonds. They're less into jewelries. You go to weddings where, the bride and groom are 20 years old and it's like a fake ruby ring and they bought a house or a car instead of jewelry. And I wonder if that's going to affect gold's value in the future.
That's a
But
very
already is affecting
interesting
diamonds,
question.
in my opinion.
What's that?
Both.
It's definitely
my daughter
affected
and my
diamonds.
niece have lab-grown diamonds. The lab-grown diamond is eating away at the diamonds thing. When what's her name? The woman from Florida who used to work for the diamond company. They were trying to
Amelia Bordeaux.
make it investable,
Amelia Bordeaux.
But I'm not. I was interested in that when we had her on the show a year and a half ago. Now I'm not interested at all.
Yeah.
Just because lab-grown diamonds seem to be taking market
What
share.
I hadn't thought in those terms. That's a very interesting concept.
But then does that make gold more valuable though, as a
something
portable
that, like
physical
I
store?
think about with my gold holdings, and I own mostly physical. I trade the futures and
That's
sometimes
same.
Sure.
ETFs, but I own mostly physical. And I think about it, and one of the things that appeals to me from a perspective of what gold is that it's essentially invulnerable. Like, yeah, they weren't trading gold for goats, for lack of a better phrase.
Right.
But a goat can die, and a gold, doubloon can survive a shipwreck and be pulled up and still have
And still have value, yeah.
Yeah, and I think about that with like Bitcoin wallets.
Right.
The ultimate catastrophe is the grid.
Yep.
Right. And if the grid is gone, can I take this little wallet and go? You
right.
got to trust me that I got Bitcoin on here.
Right.
That as soon as
But
we get
you can't
power
access
back,
it, right?
I'm going to send it to you. And again, I may be naive here because I'm not the most fluent in the Bitcoin technology. I do own some.
Yeah.
But that's more of like the same reason I believed in God for a long time. I was just afraid he was there, and I didn't want him to be mad at me. Same thing with Bitcoin. I'm afraid it's going to be the thing, so I just got to hold on to some.
That I was just about to ask a question about Bitcoin, because I'm the same way. I've been buying Bitcoin for 6 years, just a small amount weekly. It's turned into a decent sized amount. I don't know anything about it. I don't know if these guys are all crackpots and fools, but if they're right, I don't want to be left on the sideline.
Right.
What are your thoughts on Bitcoin? And we're only going a half hour each of these,
Yeah,
right?
we could be done soon.
Okay, yeah.
Well, it's interesting to me. I stayed out of Bitcoin for a long time. And then my boys said, Dad, we really ought to take a look at this. And so I did. And I finally started picking up Bitcoin. But then I started watching what's happening with China. I started watching the digital currency. I started watching everything else. And I looked at it. And increasingly, I found myself aligned with Jamie Dimon on it. Jamie Dimon famously said, this is complete fantasy land. Now, Ethereum, blockchain, that's a very different proposition. And I do follow that and invest with that.
Yeah.
But I believe we're going to digital currency, but I'm not convinced Bitcoin is going to survive.
Interesting. And so you mentioned Jamie Dimon, obviously a titan in the industry, but you didn't mention Larry Fink, who my daughter used to work in the investor relations at a large blue blood American company. And her quote to me once was, Dad, we all just work for BlackRock and Vanguard. Just some of us know it and some of us don't.
Right.
So, but Larry Fink said Bitcoin trades 50x. Do you put his weighting the same level as Jamie Dimon, above it? What do you think?
Well, here's the question I would ask, in return to that, because I'm not smart enough to answer that. But the question I would ask is, why would Wall Street suddenly embrace something that they poo-hooed for years? And the answer is because they have figured out how to stick it to the individual investor. So the fact
that's the cynicism we're looking for on our shows. I love that.
You're talking, well, think about it, right? I mean, the moment.
No, I'm with you.
Here's why I got out of Bitcoin. I got out of Bitcoin the moment I learned that George Soros and his family office were trading it.
Really?
I'm done.
Okay. Because when Larry Fink got in, I got in. I thought that's okay.
I had exactly the opposite reaction.
So I actually love this. Someone's got to get to the current vice president and say, stop saying Goldman Sachs backs your economic plan.
Oh, I'm not getting into that. I'm not dealing with that.
I don't want to be aligned with Goldman Sachs.
I do money. I don't do politics. I'm not.
We don't do politics either. These are policies. Yeah.
I'm sticking with no. But I
have one more question for you. Yeah. Just regardless of which candidate proposes these tax policies, Stephen Moore was just on the stage a second ago talking about unrealized capital gains being taxed, capital gains tax being jacked up, corporate tax being jacked up. Do you think if those things are instituted, or any facsimile of those things instituted, that the stock market could have an initial difficult time wading through those? And you even mentioned that sometimes there's volatility that surrounds the election. Could those be the catalysts of the volatility?
I think there's very clearly an element to that. I think that any kind of progressive and/or punitive tax policy, regardless of who originates it, could cause a massive dislocation in the market, but it'll be short term. What I'm more concerned about, frankly, is the long-term economic implications of whatever that is. Because my rule and my experience in the 45 years I've been doing this is that money is
Start when you were 12 or something?
I did, 15.
Okay,
15, I'm not kidding.
Okay,
I made my first trades at 15.
All right.
So here's the thing about that, right, is I look at that, money is like water, it will go to where it's treated best.
Amen.
And so if we revert in this country, regardless of leadership, if we revert to a punitive policy, a regressive policy, a policy that punishes success, my fear is that we will see a tremendous exodus of American industries that we've worked very hard to bring back onto our soil in the last 10 years. And I think what we'll see is across the planet. And I think that for reasons that are not a lot of people talk about, this has a lot to do with COVID. And the reason I say that is because when COVID hit, for the first time in modern recorded history, suddenly you had civilizations all over the world at the same time realize the Faustian bargain that they had with the government wasn't what they thought it was. Yeah. And so now you've got this idea of, I'm going to question authority, I'm going to question value, I'm going to question where my money's going, I'm going to question what's in it for me, I'm going to question leadership, and you've got businesses at the same time that have to survive that. So, it doesn't matter. It used to be in the old day, you could take your business, you could headquarter in Bermuda, you could operate in the UK, you could, and you could find some sort of tax advantage. Well, that's gone away now.
Those are gone.
And now you've got inflation that has been out of control. It's disrupted the supply chain. We've got from just in time to just in case. Not a very good mix.
No.
And you've got China, which actively wants a place at the world stage, but doesn't understand the respect that comes with that. You've got Russia over here, doing its thing. You've got the war in the Middle East. So there's a lot of conflict and cross current that is taking away the idea of where can money go next. So my fear is the political change could be the thing that says, okay, we're no longer going to have companies like we used to know them.
Nice.
We could disintegrate. We could have companies that change structure. We could have companies that I think what's going to actually happen is we're going to have a huge swath of companies go private.
Oh, that's
which is going to leave the investor with fewer opportunities, because they're simply not going to want to deal with the compliance, with the public documents, with the earnings cycle. This is 90 days of gamesmanship every time there's an earnings season.
Yeah.
So if you take a company like Boeing, for example, which is arguably a bug in search of a windshield, you can't have a 90-day cycle on something that's an aircraft that's a 10-year purchasing win. So how do you, my fear is, here's the administration, how do you smooth that cycle? Because that's the cycle that produces the value, not this, this instantaneous piece.
I've just decided I'm writing you in when I go into the voting booth.
No. Well, by the way, we should be high-fiving later because we got him to be cynical. We got him to be talking more about policy than he wanted to. He went in. So I consider this a victory.
Naturally kind guy got as crabby as us.
Yes, he got as crabby as us. And he did mention fighting authority a second ago. And just for you guys who watch, Bobby and I don't get noses like this without having a lifetime of fighting authority. And it's not going to stop today either. We have Kelly Green from Malden Economics, who is an expert on dividend investing, which is something that I'm very interested in too, because I'm turning 60 this year. It seems like income streams are something that could be quite important going forward. First of all, where do you come to us from? Where do you live?
I live in Port St. Lucie.
Are you from there?
I'm from Baltimore.
When did you move to Florida? By the way, everyone I've talked to in this goddamn show this afternoon has moved from somewhere cold to Florida. So tell me more about how wonderful it is.
Yeah, it's really funny when you meet a local and I'm like, wait, you were born here? You exist?
Right.
I was here. I've been in the financial publishing industry for like 10 years. So I moved down it's been 14 years I've been in the industry. I moved 10 years ago.
You love it?
Yeah, maybe. No.
Hold it. Do you love it in August? Is it when it's hotter?
I love it because I ride a motorcycle and I have a Miata. So like convertible and motorcycle life, I love that. I'm a Disney pass holder. There's reasons to love it.
That is pretty cool. Actually.
But I'm ready to go somewhere else next, I think. I think I might go to the West Coast.
Tell me about August. Tell me how awful it is in August.
It's about as humid as the city of Chicago.
Same level.
It's really
the problem I'm having in August is
very strange. It's like I spent most of my life in the city of Chicago, and I lived in the city, so the air doesn't really move around until you get down to Lake Michigan. So you're sitting there and you're like, why is it so hot right now? And then you come down to Florida and you're like, why is it so? Oh, it's tropical. Okay, at least there's a reason for it.
I was in Chicago 6 weeks ago, 4 weeks ago. And I was like, I think it's hotter here than it is in Florida.
Oh yeah, it was September.
There was a stretch.
Was really
that was a stretch.
But the whole summer was relatively mild. And by the way, I have a restaurant with a ton of outdoor space, so I monitor the weather very, very closely. September was like the only really disproportionate hot month that we've had in several years, actually, which I think is interesting. But it was hotter than shit.
So glad I came last month then.
Yeah, right, exactly. Okay, we're going to talk about dividends, which I want to talk about. Yeah. So, okay, my first question is going to be how interest rate sensitive, I understand that dividends are kind of an interest rate, but how sensitive they are to moves in Fed funds rate, moves in the Treasury yield curve. Is that pretty much the entire game with dividends? Because if you can get 5% on your 3-month, 2-year money, dividends are way less attractive, right?
Well, again, it's like, I think about dividends a lot differently than most people in the industry. So when I started, I'm not that old, like that's clearly obvious. When I started in the industry,
you're not as old as us. That's clearly
and that's clearly obvious.
But like it was zero. We were in ZERP, right? So any dividends, people were like, I'll take them. But I'm a firm believer that you should never get less than 3.5%, right? So first, there's that. But then we saw the interest rate go up, right? And people were like, oh, I don't need dividends anymore. But I don't think that's the case, because for me, 5% on a CD is still not good enough. Like, we can do better. So, we're actually, I can always beat the Fed funds rate.
Okay.
So that being said, I can always beat the Fed funds rate. Yes,
right?
With safety too. But the important thing to think about the Fed funds rates right now is exactly what you were saying. So we went to ZERP, right? And people were like, I love dividends, tons of dividends, right? Then interest rate goes up, people were like, oh, I forgot about dividends.
Right.
So what happened was actually people sold their dividend stocks and the yields went up, right? Yeah. So here I am sitting around going like, oh, there's a consumer staple for 4%, I'll take that, right? There's a utility for 6%, I'll take that, right? Yeah. So we stocked up on all these great companies that we could never get. And now that the interest rates go up, or the interest rates are going down, what's going to happen is people are going to have to rotate back, and they miss the opportunity to buy, right?
That makes sense.
And I've been sitting here the whole time being like, dividends, let's just keep
right.
buying
And a
them.
dividend stock is forever essentially. It's not going to change it to the downside unless there's real, obviously, financial trouble.
Exactly.
Yeah. So what you're saying basically is that Obviously, the dividend yield, a lot of people don't know exactly what the dividend yield is made up of, right? It's the dividend minus the price of the stock. You just do the math and there's your yield, right? If you look at it from a perspective of, a lot of people, I think, believe this myth that dividend stocks, dividend paying stocks, don't go up as quickly or as often or as regularly as the broader market. Now, I called it a myth. Is it a myth?
It's not necessarily a myth, right? Because at the end of the day, like my favorite stock, EPD, Enterprise Products Partners, it's a pipeline company, right? I love pipelines. But if you look at like a 10-year price chart, it's traded within $10. But you can get an 8% yield. So like,
Give me the initial, what is it going to
EPD.
And the pipeline? Okay.
Yeah, Enterprise Products Partners. So it's just one of those things. Yes, there are parts of the industry that are just going to trade in a channel, and it would be equivalent if I go buy a CD. That money's not going to get more, right? So when I look at those stocks, I care more about that yield number, right? Because whatever. But your consumer staples are still going to go up with the market, right? If you look at what happened during the last 4 years of COVID, right? Consumer staples moved very disproportionately, right? Because in 2021, as everybody was stocking up, they spiked in a way we never thought we would see.
Bit of an anomaly, though. But yeah, I mean, so the answer to his question is partially right, partially
it's
not.
partially right, partially wrong. It's going to be depending on what it is. And the other thing is dividends are across all industries. So like there are tech dividends. They're harder to find, right? But we found them. Like, we made a great gain on IBM, like me and my readers, because again, it was hated. And we were like, oh, wow, it's hated. Let's get a 4% yield in tech. That's absolutely outrageous.
Yeah.
So it is a myth, but then it's also not a myth. It just depends what section of the dividends, because it's hard. It's hard to say all dividend stocks move the same because they're everywhere. Like,
so why do you think that people that it's not their top priority as active investors to just wait for dividend paying stocks to drop a little bit and then just get in and don't worry about it from there? Is it sort of they lack the juice of some of the other high flyers?
Well, it's boring,
It's
right?
boring.
What are you going to, it's boring, right? And I love that they're boring, because the last thing I want to be doing is like freaking out watching the market. I want to be at Disney all day and check my account and be like, oh, look, I got some dividend payments today. Like,
And then you're at a dinner
day.
party hearing your buddies talk about NVIDIA, and you're like, shit, I'm missing out. And that's why people, because I agree, it should be a portfolio that's just dedicated to that, particularly as you get a little older. Can I ask you about cigarettes? They pay a lot of dividends. Why do they pay such a high dividend? Is there always the fear that laws are going to be passed, regulations are going to be passed, and cigarette companies are going to be crushed? Because I own some cigarette companies.
So cigarette dividends, I mean, I love a good investment, right?
Well, when I bought, the first time I bought it was when in the, what was the name of the health care bill from Obama? The Affordable Care Act.
Yeah.
In that was smoking was a precondition. So the insurance companies couldn't single. And I was thinking, if I'm paying for their insurance, I might as well sell them the cigarettes. Right? So yeah. Okay. But again, but go on. I didn't mean to cut you off.
Yeah. No, I love cigarette dividends. The interesting part is there are some that seem to just keep growing their dividend, but then the stock's not going anywhere, and the stock's not going anywhere because the company is not growing.
Okay.
And that's the difference. Philip Morris is my recommendation, but the problem is Philip Morris has actually gone up so much in the last couple months. Now it's above my buy up to price, right? Because I make my buy up to prices off of what yield I want to get out of something.
So is it flipped? I was looking at British Tobacco the other day. Is that what it's called?
I would still only I don't want to chase that dividend.
Okay.
So Philip Morris would still be my favorite, but we either have to wait for one of two things to happen: something that means the price drops, or they increase their dividend, right? Because they're the only two ways you can get a higher yield is if the stock price goes down or the actual dividend paid goes up. So when that happens, I readjust my buy up to price and we look for those. And there's always, that piece of news where everybody's like, oh, nobody's gonna be able to smoke anymore.
Yeah.
And then they all drop and then you buy more and then it
Can I do two questions?
Sure, absolutely. I'll just sit here.
I'll probably forget the second one once I ask the first one.
Yeah, you never will. I
never
got
remember.
you $100 right now. You won't remember the second one.
I'm betting that I won't remember it.
You won't even remember the bet. Go on.
What?
I don't know.
Okay. Is there when you look at a stock and you say you're getting paid 8% or getting paid 6% with what Jimmy phrased as little to no risk, would it be true that a stock that exists in a $10 band, like you just described, has nothing behind, I'm not saying it does, I'm asking, has nothing behind it, so it's more likely to collapse in price since it's not rallying? Like, to me, it's not one or the other as an active investor. Like, things can go sideways and you have to make a judgment as to, okay, I wasted this amount of capital with this amount of time. I'm going to take it out and apply it somewhere else where I can make gains. You obviously have the offset of the dividends, but because it's not going up over like 10 years, is it more likely to go down, or is that a myth also?
That would be a myth that it's more likely to go down because, like I said, the example of EPD is a pipeline.
Yeah.
I don't give a shit what the price of oil is.
Yeah.
Because it's going to go through the pipelines,
Sure.
and I'm going to collect my dividend. But the thing that it's different about me and how I look at it is I don't necessarily care about the capital gains, right? Those are like an additional bonus for us. So the way that we think about it, kind of with my readers, is we have two parts of our portfolio. We have our bedrock income, which is that stuff that you want to keep for your generational wealth, you want to pass to your kids, and those are your lower dividends and your like really, really no risk stuff. Then we have our current yield portfolio, which is that like riskier stuff. So those I do look for the cap gains, and I use those more as like a speculation. Like we bought a television company, right? That sounds so crazy. That always pops after an election year, right? For political ad spending.
Right,
So we speculated, but we're gonna get 7% while we wait, right? So it's about a year trade. We'll sell it in February whenever those year earnings come out. And so it just depends. On the bedrock part, I don't really care if those trade sideways, because what we're going to do is we're going to do a dividend reinvestment on those dividends. We're going to keep them for 30 years. We're going to pass those to our grandkids, and then it's done.
Do you have a portfolio designed for if you hate your kids? I'm kidding. I don't have kids.
I don't either.
That wasn't a real question.
I want a net zero, so I'm.
So the second question, you owe me $100. Do you have a baseline?
Fake.
This is made up. I don't remember the other question.
Yes.
Do you have a baseline where you say, okay, I'm not going to look at anything that has less than 2.5%, or is it like stock based?
3.5% is my like bare minimum.
All right.
I may say that, but we have one in our portfolio right now that's it was a variable dividend, but it's speculation.
Okay,
it's-
so that's what I was going to say. What would make you buy one? You think
Yeah.
there's actually upside to the stock?
Well, it's a we have an ETF, which I generally don't like funds, but we have a ETF speculation on electric cars, and it paid a dividend. It paid less than we thought. So I do have like one exception in the portfolio. I'm just being transparent in case someone looks at my portfolio and they're like,
I want to know, like, if I were to say, okay, I want to start doing more in dividend stocks, like, okay, Kelly says 3.5%, so I'm not even going to look at this. But when you're saying speculative, you're saying this is the least amount I'll take while I potentially wait for the stock to go up?
well, generally, if something is more speculative, I try and get a higher yield.
Okay.
Because I want to get paid while I'm waiting, right? That's the whole point. It's like if I think I might have to wait like 2 years for this, and then it's like, oh, it might not even happen, at least I'm getting
At
paid.
least you're getting paid. Fair enough.
Because you should get paid when your money's sitting anywhere, you know? And like you brought up CDs, that's going to be the problem starting next year.
You gotta start
is people are going to be
rolling.
like, oh shit, where's my 5%?
Right, exactly. So then you look at like an ETF, like, is it the BlackRock Enhanced Dividend Fund, BDJ perhaps? Do you know anything about it? How do they get those dividends? Is it leveraged up or something?
It's really interesting to look at what's in those because, and I don't really follow them because I'm not a big fan of funds because at the end of the day, somebody's taking a cut of that for you.
Yeah, of course.
And
And that makes sense. That's a good takeaway, by the way, too.
So-
Yeah, right.
And if you look at the funds, there's always like what they say they're doing, and then you read through it, and then you're like, oh wait, but you have all these hedges, and then like hedges are so that it doesn't go down, but then they're going up while the other part's going down. So you're actually kind of losing me. So I'm not a big fan of funds, except for my managing editor looks at them to make sure I'm beating all of them.
Okay.
So that's the only reason I look at them, to make sure that my yields are higher than all of theirs.
What specific dividend-paying sectors do you like the best today?
Today,
Well, pipelines.
I
heard pipelines.
always love pipelines.
What are some other pipeline names, by the way?
That's the one.
Yeah.
EPDs. I've been investing in EPD and writing about it to readers at different publishing companies for over a decade.
I might have something by tomorrow. Oh, it's tomorrow Saturday.
Yeah,
Yeah, right.
I like EPD, let's see, what else do I like right now? Tech, if I can get it.
What kind of tech company pays more than 3.5? Apple pays what? 2?
We did get into IBM,
Okay.
which was cool. We're out of that now.
Yeah.
But we have one that's like it's a white label, like software company. So basically you come in, you're a telecom company, and you're like, hey, I want to do this for my subscribers. Oh, I brought your white label software. But the way we got into that one was it's an exchange traded debt.
Oh.
So it's actually, we're getting like 8.75% because it's an exchange traded debt. So, you got to be creative about it.
Well, that makes sense.
So, but I'm still looking, like Cisco is on my watch list right now.
What do they pay?
It's like it hit 3.5 and like I missed it. But, but it was still around 3 last time I checked. So like, that's where you say like, I'm like, I like 3%, but my rule is 3.5%. So I try to, but telecoms, I like telecoms long term because it doesn't matter what technology we have going forward. Like, is it robots? Is it AI? Is it AI? Like, is it VR, AR? What is it? Like, who knows? It doesn't matter what it is, but telecoms are going to be really, really important because so much data, and then the latency of that. Like, we can't just have robots running around and then have latency problems.
Right.
So I love telecoms. Both Canadian and U.S. And then there's a lot of good like French telecom. There's a lot of great telecoms worldwide that pay dividends. But I think that's a long-term tech play that can be dividends. So anything is like a great dividend payer if you can think like, can we function without this?
Right. Oh, that makes sense. Yeah.
Can we function without this? And then has it proven it can pay a dividend for more than a year? And then bonus if it's increased it, right? And I don't really care if it's paid the same dividend for 5 years. Like, I'll take that.
Sure.
But yeah.
What about dividend reinvestment plans? About 15 years ago, there were commercials for these automatic dividend reinvestments. Do you guys reinvest?
So it's really funny because I'm writing my dividend digest for next Wednesday about this, because my brother sent me a screenshot last week of a dividend reinvestment account that I bought him when he was 18. So he's 30 now with 3 kids, right? Yeah. And it's doubled, right? It wasn't a lot of money, but it was the proof that a lot of the times I give these examples are hypothetical. This is a real example. The really cool thing about DRIP, and again, what I'm going to write about in my dividend digest is you saw the commercials because you couldn't do them in a brokerage account very easily, right? Because of commissions. So you had to pay the commission. So they actually, the transfer agent, right? You had to buy them through a transfer agent. But now you don't have to buy them through a transfer agent, and that's why you don't see the commercials for them
you
anymore.
can just do it yourself now, right? You
So
just allocate it that way.
Well, you just go into your brokerage account, you click the little button, but that's why you don't see the commercials for it anymore. It's not
that's
like they've
amazing.
fallen
I
out
never
of
realized
fashion.
that.
It's because you don't have to go to the transfer agent anymore and do it.
Yeah.
Oh, that's pretty brilliant.
So it's because everything's zero commission. So just do it in your brokerage account.
Hey, because we get in the weeds sometimes, before we end this, and I'm not saying we're ending it right now, where can people find you just so that we get that out of the way?
You can find me on the internet, like everybody, right? I'm on Instagram as Down Dogs and Dividends. I'm also a yoga teacher, right? So I've done that for many years. So, and then Malden Economics, I write a weekly free letter called Dividend Digest. And then I have my premium newsletter service called Yield Shark. And that's where I give out my portfolio, all my favorite bedrock, all my favorite current yield. I give a new pick every month. I do all of the earnings updates for everything, any news updates. I alert all my readers for that.
Okay, in my head I was thinking about energy, switching energy, because we talked about pipelines. But I don't know if you saw today, there was a big announcement about nuclear that the government's going to get behind that, which by the way, I hate when government gets behind shit, but that's the world we live in. But anyway, are there, within that space, electricity in general, nuclear specifically, do you see any of those utilities that are really attractive to you?
I don't have a nuclear one that jumps out, but that's what my readers have been kind of hammering on me right now. They've been sending me a ton of tickers, and I keep going through them, and it's really interesting because especially renewables, it's the big thing. But yeah, it's definitely something to be looking at right now. Who are going to be the big players? Because like with anything, there'll be a consolidation. So you want to look for the big players, the ones that have the free cash flow, but then there's a trade-off. If they pay too much to their dividends, then they can't buy new assets. So it's that, who has that balance right now? And I don't have an answer for you yet.
Speaking of which, when you see a young company that's paying good dividends, Do you think that's a negative in some ways, that they should be growing their business and making it into a big established and then start paying dividends?
It depends what it is, right? So like if it's a tech company, like that's why they can't pay dividends, right?
Yeah.
Because, and we saw it with Intel, right? Intel paid a dividend for how many years? And then it had to stop paying because it was like, oh, our chips are so far behind. Oh goodness, how did that happen? Well,
you're paying out your money, right?
You have too much. Right, so that's what to look out for. It's just making sure it's proportional, right? So there's the payout ratio, which is a very simplified way of doing it, but the payout ratio basically tells us, it's just something that you can see through your broker. The payout ratio shouldn't be over 100, because that means it's paying out more than 100% of the money it has. So if it's a company that needs to grow, be concerned. If it's like paying out 60, 70, 80% of its money, like that might be a red flag.
It's funny because one of the things that I notice, and I haven't done research on it, but one of the things that I notice is that when a company it's not a blowout earnings announcement, but they do increase the dividends, almost 100% of the time of like the two that I looked at, they report non-GAAP earnings as opposed to GAAP, right? Which for anybody that doesn't know is generally accepted accounting principles is GAAP. Non-GAAP is we say whatever the hell we want.
I can't believe he just didn't say the F word right there. I've known him for 30 years, and that was a very good restraint.
I have a fucking sport coat on, so
I
didn't want to use
don't want to look
sport
sharp.
coat. Oh, so I've always wondered if like the dividend is something like, yeah, we didn't do really well, but here's 4 more cents. Do you ever notice that? How deep in the weeds do you get when you're looking at like an earnings report?
Oh, I try to look at as much data as I can get my hands on.
Yeah.
And it's a couple weeks ago I wrote about GAAP versus non-GAAP because like you said, sometimes there is something and you're like, wait, where did GAAP go?
Yeah, exactly.
There's a reason it's there.
Yeah, like
Why is that okay?
Yeah. Yeah, and especially like looking out for those like one-time events. Like, is there a one-time event, or are they actually trying to hide something in the GAAP or non-GAAP?
Forensics. That's
It
exciting.
does seem sometimes when they up their dividends that they're trying to put a floor into the stock, but I guess your answer would be like, I don't care. I'm still getting the dividend.
Yeah, usually I don't care, but one thing I do always tell my readers and anybody I talk to is like, if you're gonna look through an earnings call, look through the call. Don't just look at the numbers.
Yeah.
Because usually a couple things happen. Somebody in the Q&A asked that, and then you can start to see how they start to get like twitchy about it. Yeah. And I always download the transcripts. But yeah, I think the thing is to see how the management reacts is more, because that's the second thing. There are the numbers, but I almost take more stock into the management and like, are they changing what they said last quarter? Because I mean, do something in the numbers, whatever. Like a lot of the companies that I deal with, they're so solid. I'm like, do whatever you're gonna do in the numbers. I want to start to see if it's gonna fall apart completely. Yeah. Like.
So when you, last question, I know we're butting up against the wall. When you construct a portfolio, do you look at its delta to the overall market? Is it relatively low, you think? Like if the S&P goes through a 10% correction, what is a well-constructed Kelly Green, what's the color? It's in my favorite. I just realized as I said it too. Right, it's one of my favorite colors. What is a Kelly Green well-constructed dividend portfolio? What is its delta to the S&P 500? If it breaks 8%, you down 3%, what? It's hard to answer.
It would be hard because again, the capital gains is not my primary concern.
Right.
So for me, if the market goes down and then my dividends start getting cut, I have a problem.
Well, then you have a problem.
Yeah, I have a problem when my dividends go down.
Right.
Because when the market goes down, I'm like, what do I like long term? I'll take more of that.
Yeah, right.
And I'll take more of that, and I'll take more of that.
That actually makes good sense.
So that's the thing is not thinking about the cap gains as primary, right? It's our income, and then what we're doing with that. Are we collecting it as checks?
Yeah.
Or
the only
are we
reason price
reinvesting
fluctuations matter is if you're making gains, or if it is an indication that the house could fall.
Yeah.
By the way, my name used to be Royal Blue, and I changed it. So I didn't like it.
Kelly Green, like it's so funny. As I said it, Kelly Green.
My brother is Hunter Green.
Really?
Yes. Yes.
Wow. Your parents knew this,
yes.
right?
Yes, it was intentional.
I thought if it was me doing it, they'd be like 10 years old, and my wife would say to me, "Hey, did you know that kids are named after colors?" Anyway, thank you so much for joining us. Thank you guys for joining us again. We are humbled by the support we get, all the feedback, the DMs, the retweets. None of this works without you. Remember what Bobby and I's mission are. We were in legacy media for a long, long time. In legacy media, you're always at the whim of some overzealous producer or sponsor telling you what you can and cannot say. We are trying to create a platform where we can say whatever the hell we want, And it might be bullshit, but it's our honest to God bullshit, and we get good guests. Thank you guys very much.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.